Good afternoon, everybody. Welcome to TraderMerlin Show. Sorry for the little bit of a hiatus. As you guys may have seen, I caught some bug. When we flew out to Austin, Texas on Saturday, we had a plane full of people who, I've never seen someone who was coughing like obnoxiously loud with no mask coverings. Of course, I wore my mask covering on the airplane just because. And everything is fine. I had a little bit of a scratchy throat on Monday night. I ended up with like 103 fever, and I was like, oh crap, not COVID, man, not again. The symptoms were pretty much the same, but I went and got a test done and no COVID, so just got a bad case of influenza, but I'm back to normal. So thank you guys so much. And for those of you who did not know, I apologize that you may have been like left in the dark while they were doing a show. If I'm gonna miss a day, I usually post it on my Twitter account, so you can just go to @TraderMerlin, follow me on Twitter, and that way you'll at least know why I didn't do a show. Normally I will tell you guys here why I'm not doing a show, but sometimes, like that one day was just literally a 3-hour turnaround from feeling okay to like appallingly bad. So I saw a comment here that stores are running out of cold medicine. Yeah, I went to grab some more lozenges and it almost gutted. It's crazy how empty the store, like the whole aisle was just gone. I was like, oh man. So clearly something's going around. Careful out there. This one's not good. It's funny because this flu is exactly the same symptoms as when I had COVID. It's just I don't have the body pains that I did when I had COVID. So anyway, yeah, I feel much better. I'm bummed I missed 2 days. We've had 4 days in a row of some of the most aggressive sell-off we've seen in like 8 months. The last time we had an aggressive sell-off this bad, it was back in June of this year. Fortunately, this is why we have stop losses, because you guys remember my show on Monday. I was talking about, I think you're going to get some good, oh no, it was Tuesday with Jerry Baldwin. That's right. The Tuesday show with Jerry Baldwin is like, what was my thought? My thoughts were that we were going to see a little bit of positivity and going in through the Fed announcement, maybe into Thursday, Friday, have some nice up moves there. Complete opposite of what I thought. I don't think I could have been more wrong on my assessment of it, which is why we have stop losses in place. So I'm out of my XLE, I'm out of my QQQs, took some losses on those. But the good news is, got stopped out on Wednesday, and if you look at the price charts, they're still going down. So, there's times where we hate getting stopped out. You're like, oh, why? Why did I get stopped out? And you look at hindsight like, man, I'm glad I got stopped out because that would have cost me thousands of dollars more. No, Gary, Elon hasn't cut me off. I'm really not a big social media person. I know if I was, I could probably have 10 times the group that I do and really make it something bigger, but I'm not a social media person. Anyway, there you go. You got my wonderful picture. Let me just talk about some of the economic data that happened this week just for fun. This is the stuff that came out today. I didn't have time to... Oh, wow. You know what? It's funny. I wonder why they tie Sam Sine to me. I don't get it. I wish that you could go in there and I could personally just say, no, this guy is nothing like me. This guy is a scumbag and mark him that way, but you can't do that on Twitter yet. So if you look at this economic calendar, this is flash services manufacturing. There's a lot of stuff that came out today. And they were expecting declines. You can see here for France. They missed on the services. They actually beat on manufacturing. But most of these, the ones that really matter here, Germany, they beat on both. You have the whole EU, they beat on both. So it's starting to show some positive data out here. Now, it's still below 50. Remember, below 50 means economic contraction in those areas, but they're getting better than they were. What else do we have? We have the UK, which missed on manufacturing, beat on services. I'll just go plus and minus, I guess. And then another piece that was noteworthy here was European Union on their consumer price index, because we talk about how they were late to the party to raising rates. I mean, it just took them forever to start to raise, and now their inflation is still going up while most other countries are starting to see theirs drop. So this is why I was making a point, kind of laughing at the euro, like, why are you not raising your rates to keep up with the Joneses? But really for the U.S., all you had down here was the services manufacturing numbers, and you'll notice we missed on both. So that painted a relatively negative picture for us this week to start off with. Or at least for today's session to start, and then I'll go to start off with is this. If you look over here, I'm going to scroll all the way back to the beginning of the week. We were all excited on Tuesday when we got that CPI number, right? It was looking really, really good. You had a 0.4 previous number, 0.3 expectation, came out at 0.1. That's coming off the heels of a decent PPI number. And then this coming week, we have core PCE price index, which is expected to be 0.2%. So this was great starting economic data, right? I can bring up a chart here so you guys can see it. And the good news is you're seeing these peaks over the past few readings drop significantly. That is going to be a very positive sign for any inflationary pressure. So good news there, although I don't think we're out of the woods yet. If you go even further, of course, we have the rate statement. And that really was the turning point, at least for me. for the market. I thought that we would actually see the market move up from there because it initially was supposed to be 75 basis points, then it dropped to 50. Came out at 50, but you may have heard some of Jerome Powell's comments. He was very adamant that we're going to keep raising. There's no mystery here that we're going to keep raising. We'll raise until we get inflation under control. So I think that spread a little bit more fear. And then, of course, we had the retail sales number, which came out the next day on Thursday, and that really set things tumbling. Now, you can look here on a couple of ones. The Empire State Manufacturing Index here, which is a pretty important one, they were expecting it to go from a positive 4.5 to a negative 1.1, which means it's going from an expansion optimistic environment to a negative pessimistic environment. Well, they actually came out at negative 11.2, so significantly worse there. That rattled the cages. And then right behind that, you can see the retail sales numbers come in, which I'm pretty surprised with this one. 1.3 was the previous number, and I'm assuming that that's for November. The 1.3 was for October. You would think that November would be higher given all the Black Friday sales and deals. They're expecting it to contract to negative 0.2. It came out at negative 0.6. Not good. When you see that big of a swing, not a good deal for the consumption-driven economy that we are. Now let's get past the big swings here from the COVID piece and look right where we are. We are obviously negative on this this most recent reading of retail sales numbers, but it's nothing that's catastrophic. And I think for whatever reason, the market really took that as bad news. And look at the price charts here. Let's look at the NASDAQ, for example. I measured this one out. Since the peak we saw on Tuesday, this is the CPI spike that we had on Tuesday. From Tuesday to today's close, an 8.28% drop in the NASDAQ 100. That is a pretty impressive 4-day drop. I mean, you're averaging 2% per day. S&P is a similar picture here. If we go from that peak right there on Tuesday to where we finished today, 7.36% slide for the S&P. So real ugly about face there for the broader markets. Now, of course, so there's a lot of speculation about why this is happening, what's going on, but the word that everyone's freaking out with is recession. So the R word is what's creeping its head up again. I personally am finding myself in that camp. I actually thought we'd see a good December, right? I kind of expected to see the last couple weeks of December be rather positive and go into January, and then it was get out of any living long and just start shorting the hell out of the market, because I think we got ugly times ahead. Now, one of the main reasons that I keep thinking the negative side of it is this. We can look at this 10-year, and while it looks good because the 10-year has been declining, right? The yield on that is getting lower and lower and lower, which is a positive sign, means cheaper money. But when we look at the yield curve, this is the 10 and the 1. It still is a over 1% difference between the 10 and the 1, and it's extending its inversion. That's not a good sign. If we were, in fact, out of this, at least from what I know from my economics experience and trading for so long, is that if we were really starting to turn the corner and look good, then this would be curling back up and moving quickly towards a flat, which means we'd be at this green line, or a normal curve, which means it would be above it. So not really good data with regards to the bond markets. This, to me, is one of the big pieces that's going to kind of keep holding pressure on this market to the south side. Yeah, I sold my puts too soon. Me too, Big M. Me too. You know what? I'm bummed that I did it, obviously in hindsight, but I just, you get this historical pattern that December is usually rather positive, and I kind of felt like we'd have a nice Santa Claus rally. Remember, Santa Claus rally is the last 5 days, so we're not even there yet. We still have another week to go before we get to the beginning of that Santa Claus rally. But yeah, I had a lot of puts, and I closed those out, took some real nice profit, and I went long, and I've given some of that profit back on my long positions. But just so you guys know, one of my main rules for the end of the year, I may do a show on this, just specifically on this topic, is the last 2 weeks of the year, I don't open up any like swing or position trades. I may, if I find an opportunity and I'm just kind of bored, I may do day trades. But I have historically taken the last 2 weeks of the year off. Just basically leave it alone. It's usually lighter volume, lots of volatility, which can be a good thing. But it seems like it's been real choppy, and it's going against what my brain is telling me to do. So I feel like I'm starting to become more wrong than right in some of my trades. So I probably will not be doing much trading these next 2 weeks. Just letting you know, I usually lighten things up significantly the last 2 weeks. I'm normally on vacation somewhere, but right now I'm just going to stay home and get better, and then we'll move on. Alexa and Siri here, you mentioned Sam, and they tell me a little birdie. Yeah. God. It's so bizarre. We were sitting on the couch the other day. What we were talking about? We were talking about, God, I can't remember what it was. I'll just say dog leash or something like that. It's like, oh, I got to get a dog leash. and it wasn't even on my phone. My phone was sitting on the table, and I pick up my phone, and all of a sudden I'm getting ads for dog leashes. I was like, okay, come on, this is ridiculous. Stop listening to me. All right, I'm going to go into a couple listener questions here just because I can do that. We have some time. I'm going to not make it a long show, you guys. My throat is, I'm surprised I haven't been coughing on the program, but let me run through real quick a couple of questions. This one's from Eric. Eric says, looking at today's, you can tell obviously I was not here on the 14th. That was on Wednesday. Jerome Powell's Fed talk. What is an SEP? He keeps referring to. He rambles off so many raw data points. It's hard to follow what he is really saying. Yeah, couple things. Number one is, I learned this early on with really my first memorable Fed chairman, and that was Alan Greenspan. Some of you might remember old Alan Greenspan. And he actually wrote in his book, he called it Greenspeak. And he says he would always find it entertaining that he'd go to testify in front of Congress and some young senator would ask him a question and be like, hey, why are you raising interest rates and doing this? And Alan would say, that's a great question, Senator. Let me get to that by saying, and he would just go on this big circle explanation where he'd do a whole bunch of stuff, say all this really compelling, interesting stuff that in no way, shape, or form answered the senator's question. And the senator would always go, thank you very much, Mr. Greenspan. We appreciate your time today. Thank you. And he basically never answered anything. Well, I think Jerome Powell does a lot of that as well. And what he's doing is he's quoting just statistic after statistic after statistic. Now, if I was to do a show with you guys and said, hey, let's talk about GDP today and focus on GDP and work on the ins and outs of GDP, what makes it tick, where the trends are, etc., you guys could probably all follow that. But Jerome Powell does a masterful job of spewing hundreds of data points. I mean, it's literally machine gunning, just puck, 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 just nailing you with so many different things. You're like, oh, GDP number, okay, core PCE pricing, okay, retail sales numbers. Was that the core retail sales? What about ADP? You start to just go nuts. So what he's pulling from is something called the SEP. It's called a Summary of Economic Projections. It looks like this. I actually downloaded one. Oh, did I? Maybe I didn't. Let me see real quick if I can bring it up for you. It's a monthly report of just data, and it looks like this, right? So you can download that. I'll give you, this is the most recent one in case you're a nerd like me and want to check it out. You can get them from the Federal Reserve. And if you scroll down, right here, starts off with GDP. That looks at core PCE inflation. So this is like the main table that the Fed's looking at to help steer its policy going forward. Let me make this a little bit bigger for you guys. It's about 15 to 20 pages of the typical report, but it breaks down everything. Here you got GDP, unemployment rate, inflation. So it's a good way for you to very quickly go through and look at just the data and projections of what's to come. If you notice here, this is the final since 2022 is done. All these dots, it's called a dot plot. Everybody's saying, hey, 4.25% to 4.5%, which is where we are today. But notice that for the end of next year, expectations range from roughly 5% to call it 5.75, or maybe 5 to 6% at the end of next year. These obviously change. This is just kind of what they're thinking right now. Any data point can change, but it's a summary of economic projections. I think it's a useful tool. And something you can download. As soon as they do an FOMC statement, they always release one right then, but I do believe it's a monthly report that he is referencing. Yeah. You know what? It's funny because, Tom, you know that when you watch Powell, you can tell when he's got a pre-written message, right? Because it's very on point. It has a good flow to it. That's why I actually prefer watching the press conference, because people will throw him a curveball. And I've seen it over the past couple of years. There's one or two times where you can see he gets flustered or he gets a little bit upset. And there's a change in his demeanor if he gets upset about something, and then he starts to say things that he shouldn't say. He just gets out of sync with his comfort zone, and he's got to always remain that even keel, right? He's the big boss. But I love watching the press conference. You should watch every FOMC press conference. 30 minutes to an hour of your day. It's great. Let's see. I remember helping push mortgages. So let's go to a couple other ones, but all right, I'll do this couple. If you guys have questions, type them in. As I mentioned, I'm gonna try to keep it a shorter show today just to save my throat. But this is one that came through that I liked as well. Gary says, well, what are the most obvious consequences of the U.S. losing its status as the world reserve currency, and how can we trade it? Well, the most obvious thing, the easiest, simplest thing, actually, I'll let you guys answer this one and let me give my thoughts on it. What do you think are the most obvious consequences of the US dollar losing its reserve status, right? So let's say it's a crazy world, the US dollar, let's project out 5 years, 10 years. The US loses its reserve currency status to, let's say, I don't know, I'll make it up, the euro, right? The euro all of a sudden overtakes and becomes the reserve currency. What does that do to the US? How does that impact us? And I guess ultimately to the second part of this question is, how can we trade it? So I'll wait for you guys to type that one in. Remember, if most of the commodities in the world are priced in US dollars, then anybody with a foreign currency has to convert their currency to dollars to buy those commodities. So for the most part, a lot of them are stockpiling US dollars or US dollar denominated debt as a hedge to their own economy. If all of a sudden things are priced in euros, imagine Japan or China, who have massive trade deals going on, and let's say even Saudi Arabia. They hold dollars because they're selling oil, which is priced in dollars. If there's no longer a need for them to convert it into US dollars, there's no need for them to carry dollars on their books. So what will happen is the world will start selling US dollars. It's not going to be as useful as it was in the past. Yes, it's a medium of exchange, but it's no longer needed for countries like Saudi Arabia and their oil, coffee and beans from Brazil. It would no longer be needed as the medium of exchange. There, you would be using the euro. So anybody holding dollars would start to sell. So what's the main way I would say to trade it? You go out there and you find a dollar currency pair, right? If it's the US dollar euro, let's say it switches to the euro, then I'd be going long on the euro and I'd be shorting that US dollar. But you're talking something that's going to take a while. This is not going to happen in a short period of time, right? It'll take quite a bit of time to... I agree with you, Ganesh. The euro yen will not replace USD. I was throwing out there an example. I would say Bitcoin probably has a better chance, but no. It was just as an excuse for us to give an idea of what would really happen out there. No, I think the yuan is way too manipulated, Ken. Yep, Liz says less demand for dollar. It's not only... Remember, it's always it's two pieces there, Liz. It's the demand for the dollar would decline for sure, but the supply of dollars coming into the market would skyrocket. So even though demand was dropping, that's one variable. It's the supply. It's China going, we don't need all these dollars. Boom, we don't need to be holding U.S. debt. We're dumping. And same with Japan. We're dumping. You know, you could see a pretty catastrophic impact for the U.S. economy. That's the main one. I think we could look at other aspects of it, like I think that would certainly start to hurt U.S. companies. Now, the multinationals might do better because they're earning money in different countries that they can repatriate to dollars and buy more dollars with it. So there's always the conversion factor for a multinational company like Apple that's doing a lot of business around the world. But personally, the simplest and easiest one, the dollar. Just short the dollar if you realize that we're losing reserve currency status. You know, I believe the statistics are that fiat currencies, reserve currencies, have like a 100-year run. There's like a 100-year timeline for them. And we're over that now as the U.S. So, you know, a change is coming. I could definitely see it happening, especially the way that China is developing themselves. Excuse me. I think that I don't see it being the yuan because it's too manipulated, but stranger things have happened, and I don't know where it's all going to go. That's something I'll worry about way, way down the road. All right, next one. So, Randy, good to see you, Randy. Thanks for the message. It's nice to know people are thinking about me out there. The other day you mentioned a fundamental analysis channel by a guy named Brian. I wanted to confirm that was his name, as I will take a look at his show. No, his name's not Brian. His name is Colin Teddards. And he has a channel on YouTube called The Investor Channel. Here it is. And I think I can actually just copy this for you and put it into... You guys can have it. I haven't had him on in a while, but there you go. That's his YouTube channel, and definitely subscribe to that. You know, as you guys know from this show, I'm a huge fan of utilizing tools and resources to help make your job easier, right? If you find something that makes your job easier and you trust it, you should do it. You know, I love using things like TradeStation's radar screener because it's such a great scanner and great filter. I know how to use it for my needs, so I love using that thing. It's worth the price of the software. There's other resources out there for scanning for markets or technical analysis, things like that. I think that Colin Teddards is one of the best fundamental analysis guys I've seen. And he's an unknown, right? He's not like this major guy. He's getting a lot bigger. He's getting a lot of traction. But if you have a specific company that you would like to check out, you just go to his page over here. And, this is his channel. And let's say you want to find out, I don't know, Apple. You go search and just type in Apple. 1 month ago, he did his show just on Apple stock. And, what's nice is he actually starts doing more technical analysis, but he really spends a ton of time breaking down the details of how the company is doing. Where's their revenue coming from? And this sounds awful, but I don't care to take the time to do that type of work. It's like hiring, for example, I redid my back patio a few years ago. And I hired a guy. He came in. He just paid $500. He designed the whole thing: hardscape, all trees and barbecues and waterfall. It was awesome. $90,000 he wanted to charge me for this. I'm like, are you on crack, dude? There's no way. So I took 2 semesters of classes at OCC, which is down the street here, and all landscape design, architectural drawing, CAD programs, and I drew out all my landscape the way that I wanted it. Very similar, but I wanted it more different. I wanted my own personal touches on it. And I'm like, am I going to be the guy that's leveling out the ground, putting in all the concrete, all the pavers, all the rebar? I like doing that stuff, but I'm too old. I'm not in my 20s anymore, so I'm not going to sit there and, worry about my knees falling off as I scoot around on my knees laying concrete all day. No way. So I found a guy through a friend of a friend who's amazing work. It could take him probably 1/10 the time that it would take me, and it was a small amount of money to pay. Again, example of using somebody else who's got better skill set than me to make my life much easier. Like Value Line. Well, Value Line, what do they charge you at Value Line, Thomasina? I have a problem paying for things. That's one of my big issues is paying. I don't like paying for stuff. So yeah, this is a great resource for you. I'd like to get him on more often. Maybe I'll bring him on in the near future. But when I first met him, he only had a couple thousand subscribers. Now he's at 123,000. So looking pretty good for Mr. Teddards over there. And let's see, do I have one more? I didn't have a lot of time to analyze this question for you, Malik, but I'll read the question here. Maybe we can have a little bit of discussion there. And if there's something you guys want me to discuss today, let me know. I have 2 things. Before I get to Malik's question, I have not done the donkey of the day. So let me do a little donkey of the day. Normally, the go-to for the donkey of the day is Sam Seiden, just because he's just a donkey, period. But I can't pick on the same guy all the time. There's other terrible people out there. I mentioned the other day that I was going to do a special show on Sam Bankman-Fried, and maybe I'll do that next week when I'm up to full strength and can do it. But you guys know Sam Bankman-Fried is going to go down. He's going to make Bernie Madoff look like chump change, amateur league. The stuff that Sam Bankman-Fried has done is just crazy. It will be an absolute movie or a miniseries on Netflix probably in a year or 2, and the story gets weirder and weirder and weirder. So he was supposed to testify in front of the House Congressional Committee on the 13th, I believe it was. That was on Wednesday, right? He was supposed to testify on Wednesday. He agreed to it. And mind you, this guy has been saying so much stuff. There's a reason that when you get arrested, they always say you have the right to remain silent. Anything you can and do and say can be used against you in the court of law. Miranda rights, right? Well, this idiot has been on every mainstream channel, news program, podcast he can get on, trying to clear his name and trying to say, I had no idea. So Maxine Waters, who's the chairman of the committee for the Senate subcommittee here, finally got him to agree to testify. And the day before he goes to testify, the Department of Justice, who's my donkey of the day, that's right, I'm calling the Department of Justice the donkey of the day, there they are, arrested him in the Bahamas. Now, why would I call them the donkey of the day for this action? Well, it's pretty simple. Sam Bankman-Fried was on the cusp of federal perjury. If he was going to get in front of the Senate subcommittee and say, I had no idea this stuff was going on, then he was signing his life in prison sentence right there because he absolutely knew what was going on. The guy who's the new CEO of the company was basically going, Sam knew. And there's documentation that he knew there was commingling of funds, that these funds were being lent out. So if he perjured himself in federal court, that's a huge crime, right? That's a real, much more than going on Fox News and saying it, right? Different level of perjury there. Federal. So he gets arrested the day before, before going to Congress and testifying about FTX. So to me, either someone is connected there and said, hey, arrest him before he does that and puts his foot in his mouth because he could go for a long time. Or the Department of Justice just has too much of an ego. Because think about it. You and me and pretty much every American that understands Sam Bankman-Fried, FTX, and what happened with Alameda Research is going, arrest this guy. He has to go to prison for this stuff. Yet nothing has been done. So the Department of Justice, I think, in an effort to save face, before he goes in front of the Senate and says all this stuff, I think the Department of Justice said, we can't have him go there without us having taken action already. We have to make it clear that we're on top of it. That's the only thing I can think of. It's just so crazy. Coffee still hurting. We got him to, yeah. Then he knew what was happening. Yeah, he can't be that dumb. You know what's going on, dude. This is one of the most massive Ponzi schemes ever, and I'm bummed I didn't see it early on. I really should have seen it. Yeah, FTA. Yeah, that was a really funny thing. And then, what's his name? Kevin O'Leary, what's his name? Mr. Awesome, Mr. Wonderful. This guy, I hope he goes down in a ball of fire too. He might be my donkey of the day. I'll give him a double donkey of the day. There you go. You can have a little double donkey of the day. Kevin O'Leary from Shark Tank, Mr. Wonderful, whatever. He was paid $15 million to go out there and literally be a cheerleader for FTX. Smart move by Sam Bankman-Fried, because you got a guy who's connected in all these social circles. So, how is he still free? Well, he's not free now. He's sitting in a Bohemian prison or jail. Mr. Wonderful. I hope Mr. Wonderful loses face on this one, because he was on CNBC the other day and testifying in front of the Senate saying this is Binance's fault. It's like, no, hold on a second. This is not Binance's fault. I think we got the double donkey look. Say, yep. Some of you might think it's Binance's fault. It's FTX's fault. FTX put themselves in this position. Binance just basically said, I'm just going to just push you over the edge. Just a little tap, and there you go. The snowball starts running, and I don't think that Binance should be held accountable for that. This was clearly a house of cards built by Sam Bankman-Fried, Carolyn Ellison, and some of the other staff there. So there should be multiple people that go to jail. But donkey of the day, in my opinion, is the Department of Justice, just because let him testify, damn it. Put your ego aside. Let him testify. You could have been at his house the minute he hung up the phone on that video conference call testifying with the Senate and arrested him right there, and everything's great. Yep, he did get snookered. Honestly, I've talked about it on this show. I think it was probably the most genius chess move ever done by CZ of Binance. And I don't see how he could be held accountable for the demise of FTX. If FTX had the funds and was liquid, nothing would have been wrong. Nothing would have happened. But they were totally illiquid. Their funds weren't there. Screw them. They're done. Do I need to rewind for the gems? I don't know, Alexa. I'm recouping it. I've been off for a couple of days because I've been sick, so I'm a little crusty here today. So, there's always gems, golden nuggets, depending on who you are. Some people like the crypto stuff. Some people like the stock market stuff, futures, whatever. All right, let me just do one more thing here, and then I'll wrap things up for the weekend. And no whiskey for me today. Malik said this when he says, in the dot-com bubble, the housing bubble, when the crashes impacted economies over the world, especially U.S. equities, high-risk assets went down, whether they were acknowledged or not to be high-risk at the time. In your opinion, what are similar high-risk assets to your view this time, which might have a domino effect during a recession, which lead to eventual economic crash? Okay, so I think what you're going to look at over the next couple of years is the need for people to have liquid assets and start pulling their money out of speculative investments. So I think that this could be a real negative thing for cryptocurrencies and digital assets, simply because it's such a speculative thing and there's no real revenue generation coming in. It's not like you're getting, earning per share off this stuff. It's just tokens, which in some cases do earn you yield if you're staking or lending protocol type stuff. But I think you'll see it right away pull out of digital assets, which we've already seen, right? You're down 80+% on the entire cryptocurrency market, which I can show you the market capitalization here. I think that's your first step with watching money pull out of very speculative investments. So you'll probably see a run on blue chips, meaning people are going to stock up on the more stable value companies out there, which will put you more towards the Dow. So there we go. Here is the total market capitalization of cryptocurrencies. You're at 770 billion right now. Back in November of 2021, we were at 3 trillion. So we're down, significantly on this. I think that that's your first step where money gets pulled out of that. If you look at diamonds, the Dow has actually been pretty strong. Why? Well, because it's the big blue chips, right? It's the bigger companies out there. So I think you'll see money pull out of the speculative securities, Teslas, your snowflakes, things like that don't really have a proven track record quite yet, or still have a lot of potential obstacles ahead, and that need consumption, right? If we go into a recession and people stop spending money, vehicles are probably one of the things that get hit hardest first. Well, Tesla needs people to keep buying Teslas, or obviously they're not going to be making any money. So if the economies start to slow down and people looking for cash, basically reining in your savings and pulling out of speculative investments, I may not go out and buy a new Tesla. Not to say that Tesla's a bad company, you're going to tank, but it's going to start to lose demand because people won't be able to buy a $100,000 vehicle. They're going to go look at the, Hyundai Sonata and see what I can get for 20 grand. So I think that'll be one of the major places first, is money out of speculative investments. And then I think what you're looking at is discretionary purchases, things that you don't necessarily need. You might want them, but we'll probably start to be more frugal in what we spend our money on. What does that do? That starts to create a cyclical downward spiral where you see more higher unemployment, and that leads to a cascade into every market. So you've highlighted here, Malik, a few different ones. You said, will it be equities, crypto, forex, currencies, real estate? All of this. It's not like you can say one. They're all going to get hit. When they say there's a rising tide floats all boats, we see, markets doing well and everything typically goes up with it. If we do get this implosion in the equity markets, which I don't know, man, I'm not a big believer that we're going to see a massive crash anymore. I feel like it wants to go down, but the data is starting to get better. You're seeing better economics out there. Now, of course, there's still some pieces that are not looking so good. Inflation is still out of control, or still higher than normal, but it's starting to come down a little bit. So if it does roll over, you're going to see the housing market start to tank. If housing market tanks too much, then people may not be able to make their mortgage obligations. If that happens, you start seeing more foreclosures, and then housing prices start to drop significantly, a la what we saw in 2008. Will it be as that magnified? Not in my opinion. I don't think it'll be that magnified. But, how do we play it? Well, instead of looking for the thing that's going to be going up when markets crash, just short the market. I think that's the easiest way. If you believe that this is not a dot-com bubble, but just a bubble bursting, short the market, right? Buy SH, inverted funds, short futures, use options to create money when markets sell off. That's how I look at it. Because retail money is still going to Tesla. Elon sold $4 billion. I know. It's funny. So I don't know if I told you. I think I did tell you guys. I sold a bunch of Tesla puts, and I sold them when we were back up. It was a month ago, so it had to be third week in November. So right when here at around 180, I sold I think it was 180 or 190. I can't really remember the exact date, but 180. Let's say 180. I sold the 140 puts. You can see my line on here, and I collected like $9 worth of premium. I gained a lot of money there for 30 days. And today we're going to expire worthless. So luckily, I was really surprised to see it drop. It's gone from 200 to 150 in 2.5 weeks. Pretty impressive there. But yes, retail money is still going into Tesla. However, I don't know how long money will be flowing in. If money gets tight, Big Ab, I think you would agree. If you're sitting there going, man, I don't have enough money really to pay my grocery bill and all my utilities, but I'm going to buy myself a new Tesla, I'd call you an idiot. You're not going to be buying no new Tesla if you can't put food on your table. And with these inflation numbers, it's making that dollar you have doesn't go as far. So I think this is part of the reason that you're seeing Tesla tank is just the value of the dollar and knowing that the inflation is hitting it so hard that people are foregoing purchasing a new Tesla. Yes, they're still buying. Yes, they're still selling the numbers. But at some point, I think that's going to slow down a little bit. I will probably sell puts again on Monday. Let me go to a weekly here. I'll go way out of the money. I'll see what the premium is, but I may go down here. 140. I may look at the 120s, or maybe even down here, the 95s. If I can get decent enough premium for the 95s, I will probably sell those on Monday, just because it's been falling so fast that people are scrambling to buy puts. I agree with you, Chase. At $50, I'd load up on Tesla. I definitely load up on Tesla. I don't think that they're going to go away at this point. I think they're looking pretty damn good for the long haul. Let's see, Ganesh, what do you say? Are some stocks hold for medium? And Ganesh, if you have questions specifically for me, put a couple question marks before, like Tom did right after you, just because that's I know is addressed to me. Ganesh, some stocks I hold for medium to long term. I have a stop loss. Mostly it hits and runs away. Without it, you risk a lot. How do you handle this? Easy. I just put a stop loss on it, and I don't care. I got stopped out on my QQQs. I got stopped out on my XLE. I don't care. It's a loss. I had a number in there, and what I'll do is once I get stopped out, I'll reevaluate the situation. And maybe the situation changes and it starts to move up, and okay, maybe I can buy back in, but I have to have stop losses because you never know if your stock is going to do this. So let's go to Carvana. You never know if it does this, right? So let's say you bought it right here. I think everyone would agree at this point here, I think you'd all look at this chart and go, man, this thing looks great. Buy the pullbacks, right? You're buying the pullbacks in this big uptrend. So you bought it here, let's say at 290. Okay, great. I put my stop loss down below these lows. All right, so let's say I bought 295 and my stop loss will be below this guy here, which means stop loss is 280. So I got a $15 stop loss per share. Great. Oh, looking good. Boop. And stop me out. I'm out. Now, maybe I take another stab at it down here at this demand zone right around 235. Okay. Oh, stop me out the same week. But if you just kept holding that without a stop loss, you don't know when your company's going to turn into Carvana. I'm pretty sure that most people here would look at this Carvana chart back of this one and say, these guys are doing great. It's an awesome company. Love it. Wah, wah. Now it's a joke, right? So this is why you have stop losses, because you just never know. And even ones like, I think I left some of the markings on here. You never know when your stock does this. This is Netflix on a weekly. Jim Cramer back here in January of this year said he loves Netflix. He said buy Netflix when it was at $597 and it fell all the way down to 161. You may get margined out by that point. So that's it. If it hits your stop loss, get out and don't have your stop loss at a price point that you're comfortable with, that you don't get too frustrated if it gets stopped out. Nobody likes to lose. I mean, I don't wake up every day and say, God, can't wait to lose money today. Nobody wants to do that. But what I can't do is I can't go, man, I lost so much money yesterday, I want to throw up. And usually that happens because you don't use stop losses. Let's see. Tom, was FTX involved with staking at ridiculous interest rates and excessive margin? No, they didn't offer staking. I never saw them as a lending protocol. So I don't have, so I have a grid. It's got like 29 different companies out there in the lending protocol, lending protocol world for crypto. And I give that to my CIL students. And, I run through all sorts of different brokers like Gemini and Coinbase and Binance and 20 plus others that paid yield. And you could go to these sites, deposit your crypto, and either earn through lending protocols or earn through staking. And FTX did neither. So I didn't see them offering staking or yield, especially on the US site, because they couldn't. So they never did that type of thing. What they did behind the scenes, who knows? It was excessive margin. More importantly, it wasn't just excessive margin. It was because they created a token that was absolutely worthless. And for some reason, they kept buying it up. And I believe that FTX probably bought their own token to drive up the price. So it looked like this token had a lot of value. And they were using that as massive collateral for other loans. But really, the token was worth nothing. And you had no voting rights. You had no say in what happened. You didn't earn any staking. You didn't earn any dividend. You're nothing. It was just a token created thin air. It's like if I created a little sticker and gave it to you, you'd be like, ooh, wow, I have a sticker. That's pretty much all it was. It was like a little sticker that said, hey, you have FTX, but you don't get anything for it. Let's see. If Tesla would need another showman like Musk, Iacocca, Jobs to keep inflated stock price. Yeah, I know. The big question there, Tom, is does Elon Musk's actions with Twitter now take away from his actions at Tesla? And my gut tells me yes. My gut tells me that's part of the reason why you're seeing it. It's like he's the Jobs of Tesla, and he's no longer there because he's trying to get Twitter going, and that's another shit show. I mean, Twitter is just a mess right now. Well, they were lending just from FTX to Alameda. Correct. Not to external. So I couldn't deposit my tokens and earn yield. They were just taking your deposits and lending those out without you even knowing. At least these other firms like Celsius, Voyager, BlockFi, Nexo, they were paying you for it. You knew your crypto was being lent out, but they were paying you something. Okay, I'm fine with that. I nominate Elon as the #1 person that wakes up every day looking for new ways to lose money. Can be looking at emerging markets. It's not my area of expertise. We can always look at them, but I don't even have charts of them up here. But maybe I'll start incorporating in. We'll get in Russia and Brazil and India in there. If U.S. goes in recession, at least they'll benefit from the U.S. fall in the not really, Ganesh. There's emerging markets tend to do well in growth periods. So we're not in a growth period. There'll be a contraction globally. So it doesn't matter if the U.S. markets start to tank. It's not like all of a sudden, Brazil and Russia and India are going to just be soaring markets. To me, from my experience, when you see the market start to turn there and really rock is when the U.S. equity markets stall out and are just about to turn back up. Then emerging markets just go parabolic. Okay, that's where I'll earn a greater rate of return, but just not somewhere that I focus on. If anything, I'd be doing some of the ETFs that represent those markets as opposed to investing directly just because of rules and regulations in foreign markets. All right, let me go into the last question here because my throat's already starting to cough more, so I need to get out of here. Here is your calendar for the 19th. Now, there's really nothing on the earnings front. You got a couple small name companies, but no big deal. For Monday's session, you really have the NAHB housing market for the U.S., and that's pretty much it. There's really not a lot else going on. I do have the Bank of Japan listed as making a rate announcement that's tentative for Monday. That'll probably be Monday evening, and they haven't changed their rate in a long time. It's been negative 0.1. I'm like kind of expecting them to do something with their rate, just because their currency has been just beat up so bad that maybe they will raise it up to a positive number just to get a little bit back on track. But I don't know. I don't think it's going to happen at this meeting, but I think it's coming in the near future where you see the Bank of Japan finally go back into positive territory. Remember, the Swiss was at negative 0.75, and now it's positive. So, all right. Well, sorry for taking the last 2 days off. I just couldn't even speak for the last couple of days. So at least I can speak now, and hopefully I'll be perfect by Monday. If you guys have something particularly you want to discuss for next week's shows, let me know. I'm going to have Bill Addis on the program on Tuesdays, and I might see if I can get another guest or two on for that week. As you know, it'll probably be a light week, especially near the tail end of next week as we get ready for the Christmas break here. The markets will be closed, not this coming Monday, but the next week. It's actually closed on the 26th, the day after Christmas. So a lot of people taking a very extended weekend, so I expect the market to be very thinly traded on Thursday, Friday, but there will be some action, and I'll see you guys on Monday to discuss that. If you have anything you want personally covered, you can email me at TraderMerlin@gmail.com or put your comments down below the YouTube video and say, hey, I'd like to talk about this, that, or the other thing, and I will discuss that on the shows next week. Take care, everybody. Have a fantastic weekend. I'll see you next week.